Hello, I'm Peter Towers for ESS BIZTOOLS. Welcome to Accountants Minute. Accountants, don't forget the early stage innovation companies. The early stage innovation companies commenced in Australia in July 2016. Unfortunately, there wasn't much publicity at the time because the government had gone through a caretaker period prior to the federal election. This meant that there was very little promotion out of Oz industry to the concept of early stage innovation companies. I share this with you because I wonder if a lot of accountants are unaware that early stage innovation companies legislation is operating in Australia, and some companies have taken advantage of it to help them raise capital. I was reminded of all this last week when an accountant rang me and asked me to comment on a company that he was giving some advice to. He said the company was under 2 years old and that it had spent a significant amount of money on research and development and that it had developed a new product. And he said to me, I think they're well placed to be a crowdsourced funding company. What do I think? And I said, no. Well, I think he was a little bit taken back when I said no. I then explained that I thought they fitted the criteria rather well to be an early stage innovation company. And he then said, what's that? So it was obvious to me that he hadn't been aware that the government had legislated for early stage innovation companies. So what are they? First of all, they're the running mate to crowdsource funding. At one stage, the government was trying to get the legislation for both early stage innovation companies and crowdsource funding companies passed at the same time. But that didn't happen because of the variations that occur in federal parliament. And early stage innovation companies legislation was passed about 9 months before crowdsource funding. But early stage innovation companies encourages companies that have developed innovative products or services to have a go, but it also gives some encouragement to investors to seriously look at these companies because there is a tax offset available for investors based on their investment, and there is a capital gains tax exemption that is available in some circumstances. A company that qualifies as an early stage innovation company also, in my opinion, has a significant advantage in the marketplace when it comes to raising capital. Because as investors become more aware of the existence of early stage innovation companies and the taxation benefits that they can obtain if they have invested in those companies, I think they'll be on the lookout for appropriate early stage innovation companies to invest in. To qualify as an early stage innovation company, a company must pass 2 out of 3 tests. These tests are the early stage test, gateway test, and the principles test. So let's have a quick look at what's involved in them. Every company must pass the early stage test. The company must be under 3 years old, although there is some opportunities for companies aged between 3 and 6 years of age to qualify, but I'm not going into that today. Expenditure in the previous financial year must be under $1 million. Income must be under $200,000 in the previous year, not including any grant income under the Accelerating Commercialisation Grant. And the company must not be listed on a stock exchange anywhere in the world. So if the company passes that test, they can then move into the gateway test. The gateway test is 7 questions which the company can earn points for positive answers to those questions. And if there is a positive answer, the company must be able to substantiate that answer. So the questions relate to research and development expenditure. If it's more than 15% of the company's expenditure, they earn 50 points. If it's more than 50% of the company's expenditure, they can earn 75 points. If they've participated in the Accelerating Commercialisation Grant, they can earn 75 points. If they've participated in an accelerator program, they can earn 50 points. If they have registered a patent or a plant breeder's right anywhere in the world, they can earn 50 points. If they have registered an innovation patent or a registered design anywhere in the world, they can earn 25 points. And if they've had arm's length investors contribute $50,000 or more to the company, they can earn 50 points. And if they have entered into a commercialisation agreement with an organisation named under the Research and Development Act, they can earn 25 points. So if they can earn the 100 points, they have qualified under the gateway test. But if they don't, all is not lost. They can then move into the principles-based test. To qualify under this test, they need to have developed new or improved products, processes or services, marketing or organisational methodologies, which have high growth potential, that can be scaled, in other words, go into other markets, that can appeal to broader than the local market and which have competitive advantages. So that's the company side of things. What's in it for the investors? Well, the investors are entitled to a tax offset based on their original investment. The maximum tax offset is $200,000, and that will only be available for a sophisticated investor. The tax offset is calculated at 20% of the investment made by the original shareholder into the company. If the investor is not a sophisticated investor, they are therefore defined as being a retail investor, the maximum tax offset is $10,000 because the maximum investment that a retail investor can make is $50,000 in a 12-month period to a company. And the other side of the benefit for investors is there is a capital gains tax exemption. If the original shareholder owns those shares for more than 1 year and less than 10 years, they do not have to pay any capital gains tax on the sale of those shares. So that's a great incentive for investors. And the real benefit for a company in qualifying as an early stage innovation company is getting access to these investors who are quite happy to invest in a company if they obtain the tax offset and the process to utilise the capital gains tax exemption. All of these companies are still going to have to go through the process of market research, a marketing plan, business plan, budgets, cash flow forecasts, information memorandum, share valuation determination, valuation of the company. So there's a lot of work in this process for accountants in helping a company qualify. So when I explained all this to the accountant who had rang me, he was a lot happier because he believed the company would pass the gateway test. And I'm now waiting to see the results of the evaluation that he is going to have with that particular client, and hopefully we'll agree that they meet the requirements to be an early stage innovation company, and hopefully they are all then going to be able to convince potential investors that this is a great company to invest in. If you would like to participate in a free webinar on early stage innovation companies, opportunities for young companies, and also opportunities for accountants, please join us on Wednesday 14th of June at 12:30 p.m. Australian Eastern Standard Time, and we will work through that webinar with you. If you would like a free article which we have on early stage innovation companies, or you wish to register for the webinar, please go to our website www.essbiztools.com.au. Thank you for listening. Have a great day and good luck with early stage innovation companies.